All right, guys, welcome back to We Talk Money. This is fear-mongering episode 119. There is big looming trouble for stocks and crypto, and we're going to talk about why the world is ending, markets are going to crash, and everybody's screwed. What do you guys think? You want to lean into the fear-based angle?
It's what people love so much. I mean, they want to hear the fear.
We figure we're too rational and we balance things too much, guys. We're gonna get people riled up and let's just talk about why everything's terrible and ending. But
I'll be quiet a lot this episode probably.
Yeah, Nikki's too bullish for this show. You can talk later. Let's me and Trav instill some good old fashioned fear in people.
Hey, listen, if Nvidia saves us all after the market closed with their earnings, then maybe we can get bullish again.
You're right. Nvidia is going to save everybody. It's going to save crypto's legal troubles. It's going to save the climate. It's going to save what else is bad? Mortgage interest rates will come down if Nvidia goes up. It's just going to solve all the issues of the world.
Hear, hear.
All right. In all seriousness, let's talk about the bad stuff first, because there are some looming risks for the economy and specifically the stock market and even more specifically crypto in general. Let's actually just start with crypto. Let's talk about the biggest thing that I think is the biggest risk to the crypto ecosystem, which is not really a black swan because people know about it, but it is what was on the very front page of the Wall Street Journal today, which is the fact that the DOJ is very much likely getting ready to bring the hammer down on Binance over accusations that they have been laundering money for Russia, right? And look, crypto exchanges have been under attack for the past year because of all of the securities regulation hoopla. That is its own separate issue. This issue that we're talking about with Russia money laundering is a very serious issue, and it is completely different than all of the unregistered securities discussions that we've been having and all of the lawsuits that have been filed with the SEC. This is coming from the DOJ, which is potentially criminal charges. And let me see if I can find, oh man, I have so many links up. John Reed Stark, who was a former SEC guy, has been tweeting a whole bunch of anti-crypto stuff. So I pay attention to what he says, but he actually tweeted earlier today talking about why he thinks the DOJ is about to or has already filed under seal Binance-related criminal indictments. And he was talking about how the Wall Street Journal reported that through layers of intermediaries, Binance's clients can turn funds at sanctioned banks into balances at Binance, while Binance also enables peer-to-peer trades of rubles for digital tokens that frequently involve banks that are on Western blacklists. So as if Binance didn't need more heat, this is really, really, I think, just a systemic risk for crypto, because if Binance goes down, so does hundreds of millions, if not billions, in market cap value for a bunch of crypto tokens, because Binance has been the number one player in altcoins. And so what does this mean for crypto? What does this mean for Bitcoin? I think there's a lot of implications. But before I give my opinion, what do you guys think about this?
So Binance is so interesting because there's always been this shroud of mystery around it. And they've tried to become, I guess, a cleaner shirt, so to speak, in the past couple of years. And, there's Binance US, et cetera. But there's just so many weird, shady things that seem to orbit this entity. I mean, even connections between Binance and Tether have been demonstrated out there by some people. So it's obviously a big deal because they're a big player in the crypto ecosystem. And it seems very clear that the US is putting a target on their backs. And so at some point, this comes to a head. And so we've been waiting for that shoe to drop. And it seems like maybe we're on the cusp of that now.
Yeah. What I think is going to happen is we're going to see the Wall Street Journal. One day we're going to wake up and all the news outlets are going to be talking about criminal files that are charged against Binance. And I think we're going to see a knee-jerk panic reaction in crypto, probably Bitcoin too. But I think this is actually bullish for Bitcoin in the fact that a lot of people are going to panic sell altcoins into Bitcoin, right? And what would that look like? Well, we would see the Bitcoin dominance go up even more. Right now, it's sitting right around 49 to 50%. I think that would just give it another leg to the upside. We could see Bitcoin's dominance go into the mid 50s, maybe as high as 60% if things got really, really nasty. Would Bitcoin's price go up? Probably not immediately. It would probably panic with altcoins. But I think that as people sold altcoins for fiat, some people are going to sell altcoins for Bitcoin. And so that's going to attract more capital. And so I think longer term, is it going to affect Bitcoin? Probably not. In the short term, yeah. But I do think it's net bullish for Bitcoin as far as the percentage of capital in the crypto ecosystem. And I think it's just going to cause a mass exodus and a washout of a lot of altcoins that, in my opinion, are still overvalued. I know that's probably not something that people want to hear, but I think that is the looming risk in crypto right now. That's probably one of, if not the biggest risks, is if there's criminal charges and if Binance ends up either going down or getting even severely restricted from what they're already able to do. And there's been some FUD, and I'm still trying to figure out what's true and what's not true. Looks like, the on-ramps are starting to get cut off in Europe. In the US, it's obviously a whole other story, but Binance is getting attacked from all corners. And I think the most serious and the most heavy-handed would be an actual DOJ indictment.
It'd be really interesting too if the SEC, really goes hard, or the SEC and the DOJ go pretty hard after Binance. And then to sort of throw crypto a bone later on, 6 months down the line, they can maybe approve some of these spot Bitcoin ETFs that they're going to court over. It's going to be really interesting. But yeah, ultimately, I think I could see a path here where Bitcoin is the ultimate beneficiary of all this. But the on-ramps to crypto seem to be getting few and fewer. So that's got to be a challenge, I think, too.
Yeah. So, yesterday I did a video talking about my thoughts on Bitcoin and the bull market that we've been in since the beginning of the year. And after reading some of the comments, I'm like, wow, people, there are a lot of people that are really just not dialed in and obviously don't watch price every day like we do. But the short recap of Bitcoin's price and really what's been happening over the past 8 months or so is in early January, we went from an extended bear market, just talking about the price action. I don't care what your opinion is. It's based on the technicals. We went from bearish price structure, meaning we were below the moving averages, the 100 period and the 200 period. And we were making lower lows and lower highs throughout really since November 2021. That changed the first half of January of this year, where we started making higher highs and higher lows, and we got above the moving averages, right? That's what price structure means. Doesn't matter what your opinion is. That's what the price is telling us. Price action is truth, right? As of last week, about a week ago, we had price that closed below the moving averages for the first time, came back to 25K support. And so now it's a little less clear if we're actually shifting into a short to medium term bear trend, or if this is another dip like we saw back in mid-March, where we dipped down to 19K. So I bought a little bit here, but I am prepared for prices to go much deeper. I think a lot of that weighs on what happens with the S&P and the NASDAQ here, which have had a pullback over the past 2 to 3 weeks. They are still now just kind of getting into that 100 period moving average support zone. So I want to hear y'all's thoughts on that. But again, none of this matters because Netflix is going to save us all.
Nvidia.
Oh, Nvidia. What am I talking about?
Yeah.
Nvidia. There we go.
Easy mistake.
I'm even typing it wrong. So yeah, right now Nvidia is hanging up around all-time highs after ripping everybody's faces off. And this is still, I think, one of the most undervalued stocks in the market. Is that right?
Well, if you call 25 times revenues and over 50 times backward-looking earnings, then yeah. But, Nvidia's growth is on pace to be absolutely enormous this year, potentially double sales for the year. So yeah, they're looking a little bit better on a forward basis if you look into the future, but it's going to be really interesting to see if they can meet those high expectations. I mean, the stock's up like 200% year to date. So it's got a lot of high expectations built into it. And when that happens, it's typically tough at a certain point, beyond a certain point, to keep beating those high expectations. But yeah,
when does the thing run out of buyers, right? Like that's the thing is, yeah, it can stay expensive for a while, but eventually it's gonna get to a point where it's like, who is left to buy?
Yeah, that's right. I think it will be interesting. We've heard like reports. If you think back to the pandemic, we had these crazy effects with some of these companies where they saw a huge, think about Zoom, right? They see a huge boom in revenues for a couple of quarters, and then that bullwhip effect takes place. And all of a sudden, a year later, it gets much, much harder as they're lapping those extremely high growth rates to be able to sustain that. And so the excitement starts to wane, and even the share price starts to wane. And I think that could be what happens with Nvidia. I just don't think it's going to happen yet, because we're still hearing that people are just jumping over themselves. VC firms, countries, firms are all jumping over themselves to buy these A100 and H100 high-end GPUs. And Nvidia is basically supply constrained. They can't even meet all the demand that's currently out there. And there's probably a lot of double and triple ordering happening, which means, for now, things look amazing. And they'll probably even guide to greater numbers next quarter. But if you look maybe 18 months, maybe even 12, 18 months out, I think it's going to be very hard to sustain. And if you do have double or triple ordering, then you're going to have a problem at some point with cancellations and things not looking as good as people had hoped. So it's sort of like the hype cycle in a way. It's like, we're probably not at peak hype, but we have to be getting close. So that's kind of my overall thoughts on Nvidia. But as far as this market correction is concerned, like what market correction? I mean, we corrected like 4% in the S&P before we're bouncing almost 2% today. So we get a 5% correction in stock markets about 9 out of every 10 years. And we get about a 10% correction or more about 6 out of 10 years. So I had hoped that we'd be in one of those 6 out of 10. I'd love to see a deeper correction. I think it could still happen, by the way. I'm still a little bit concerned about some of the things I'm seeing out there, like weakness in the regional banking index. Obviously, what's happened with rates, and particularly mortgage rates and housing, I think is probably going to look worse than people are thinking right now. And I don't know. Retail's been really bad. Not all of it, but certainly pockets of it. And you've had big gap downs this week in some retail stocks. So it's not all roses out there. And I would like to see a bigger correction. I'm hoping we get it.
Let's talk about some of the other looming risks and trouble for the markets. We just got another higher high print for mortgage rates, which are now sitting around 7.5%. The official number is 7.31. Spicy. Yeah, this is the highest since the early 2000s. And we talked about this last week, how this is basically looking like a breakout pattern, which is not the kind of breakout that we want to see. This is also bad for longer term interest rates. But as of today, 30-year yields are actually coming down a little bit. But I wanted to ask you guys about that. And also, this is a tweet, and a bunch of people have been talking about the debt to GDP ratio, which is now around 119%. And this is something that, again, the fear mongers really like to hammer. And I want to hear kind of a balanced view on this. Does debt to GDP matter? If so, how? And what are dangerous levels? And are there any examples that we can look at as maybe a bellwether for when we're getting into trouble, or where safe levels are? Because I know, we are, I think, at the highest levels that we've been at really ever, and things have gotten progressively worse over the past 2 to 3 decades. So where are we, and is this a looming trouble for the market?
So I love this debate, because it's always fun for everyone to freak out about government debt to GDP levels, the U.S. deficit and debt levels hitting all-time highs. Like we We see the headlines every year, right? The reality of the situation is, while it's bad, and we are at, as you mentioned, the highest debt to GDP that we've had since World War II, it's bad, but go look at other countries that print their own currencies like Japan. Japan's at over 200% debt to GDP. Now, I'm not saying we want to emulate them, but 119% debt to GDP sounds high, but it's not an actionable thing for investors. It doesn't force any sort of catalyst or crash. I love seeing people that say, oh, we're right around the corner. The crash is just about here based on debt to GDP levels. It's like, have you looked at Japan? Japan is like 10, 15 years ahead of us. And in terms of demographics, debt to GDP, et cetera, Japan proves that there is no hard limit on debt to GDP levels for countries that print their own currency. Oh, and by the way, the world's reserve currency, which is still really not significantly challenged. So yeah, while it's concerning, I mean, you're running about a 5.5% debt, a 5.5% deficit this year. So you're continuing to add to the debt to GDP levels as we go forward until the budget gets reined in. But it's not actionable. It's not actionable short-term or medium-term for investors. So people can call for crashes all they want every year based on debt to GDP, but it's not really something that's going to force the economy into a severe correction. What would actually force a severe correction is big changes in the government budget. So if the government decides to go from 5.5% deficit to GDP, and they all of a sudden say we want to balance the budget, that actually does create fiscal pressure. And even though it's the right thing to do for government finances long term, it would actually create a big headwind for the economy and could tank the market. So it's really the changes in how the fiscal spending will impact the market that I watch, not the overall debt to GDP numbers.
Trav, I have a question on that. How do you account for the fact that like government debt turns into consumer assets, essentially? Like we're buying treasuries, we're getting yield, we're all over here, earning all of this interest that we're going to pay taxes on. And so how do you kind of put that into the equation with debt to GDP arguments?
Yeah, it's a great question. I mean, economists like to bucket the economy in three major buckets. You've got government, corporations, and consumer/individuals. And when you look at how those balances pull from one another, if you have government deficit spending, it actually feeds incomes in the corporate and individual sectors. And so you're right that basically governments running fiscal deficits means that we are at a higher spending level from the consumer side and the business side than we otherwise would be. And so there's like these accounting identities, if you look at how the national accounts flow, that basically shows you that governments directly spending in terms of fiscal deficits creates higher net wealth for consumers and businesses. And so if you take that away, it's kind of what I was just saying. If you were to take away the government's deficit spending, that would actually impact the economy negatively. Now, maybe you could make the argument that that's still healthier overall, even though you take away the deficit spending, you give consumers and businesses, more reason to invest in private operations, right? And you don't have the government crowding out private investment. You don't have the weird things that happen with government policies that can benefit certain groups over others, right? So there's arguments to be made that government shouldn't be playing as big of a role in the economy. But the reality, the economic and accounting reality, is that government deficit spending does actually net help the corporate and consumer sectors.
So, Trav, you say that this is not actionable for investors, right? I want to play devil's advocate and also just like kind of entertain the bear case. Like, when does this become a problem, and when does it potentially spiral out of control? And if it does, is it going to be too late to take any action? Just something that was added on in this tweet was the government spending is so high that 1.8 trillion in bonds have been issued over the next 6 months to cover the deficit. In just 3 years, we've borrowed over 8 trillion. By 2050, the debt to GDP is expected to hit 225% in the US. Doesn't higher interest rates create more of a problem for this? And if so, when does it become an unsustainable problem? And what does a healthy reversal look like? And is there one on the horizon, or is this truly like just something that's going to continue to get worse and worse and worse until things break?
It's a great question. To the first part of the question, again, I think if you look at other countries like Japan's at 263% debt to GDP. So is there a hard limit to where the debt to GDP numbers can go? There probably is somewhere, but we haven't found it yet. And hopefully Japan will show us that first. because we're quite a bit of ways, even if we have consistent deficit spending. I mean, even that tweet you showed suggested that we're not even really at Japan's current level until like 2050 or whatever that number was based on current projections. But yeah, we ran massive deficits during COVID. It created all these weird situations for consumers and businesses that really put the economy out of whack in a lot of ways. And so I do think like there is a problem with government playing such a large role in the overall economy. And so I also think that given the political situation in the US, when you have, significantly changing policies based on fiscal spending from administration to administration, you create a lot of uncertainty in industries and businesses. I mean, go look at, what's happening in, say, like we had this Inflation Reduction Act that was passed where they're going to pour all this money into EVs and to alternative energy infrastructure. Well, that's actually creating a strain on power grids. It's creating higher power prices for consumers. It's really hurting the oil and gas industry and their ability to invest in production, which in turn is creating higher prices at the pump for consumers. So these are the types of things that I mean when I say the government having such a big role is really skewing parts of the economy in negative ways. And so I think like if we could get back to a level, maybe we run very thin deficits and we can then manage that debt to GDP to at least keep it flat. I think that would be an ideal goal. But yeah, again, I think it's hard to say that there's a hard limit when we haven't really seen that limit found. And I think we're at 120% debt to GDP today, and it looks like we could probably go a lot higher before it really becomes a self-sustaining or runaway problem.
Yeah, I mean, and this is what I see in the Bitcoin space a lot is like these numbers are quoted, and I think rightfully so. A lot of people are, they're skeptical of government intervention, and the government spending is absolutely like out of control in certain cases. And, you get articles like this where it kind of shows, like we're in a debt spiral, right? Like we're doomed, and like things are only going to get worse. And we're in the US national debt black hole, right? And so a lot of people, they think about this and they go, okay, this is something that is outside of my control. What do I do? What does the end game look like, right? And people like to really lean into this fear-based narrative. And I share the same sentiment as a lot of like Bitcoiners that it's like, look, man, like you can't print your way out of certain problems, and at some point something does break. So what can you do? I think actionable steps are one, own Bitcoin, maybe own some boomerangs, some gold, own, fiat denominated assets that as inflation goes up, the price of those assets will go up, right? Even paper stocks, right? Even paper equity. So I think that's one thing we can do, but I don't know. I guess whenever I see speak to people that are hearing all the fear porn out there and say like, if it does go bad, this is what it looks like. If it doesn't go bad, what does that look like? And how can people kind of plan around all of this hysteria that's being passed around out there?
Yeah, it's a great question. I mean, I think also it's interesting to think about how to like wargaming this if it were to become a severe issue. And it's actually a pretty easy fix. Like if you're running the US government, and sure, printing is going to create inflation, it can create all these other issues, but as far as like a debt default situation, it's really not on the table with a country like ours that prints its own currency and actually still is able to maintain the currency value, at least for now. I mean, tomorrow the US government could say we're buying back every single treasury in existence and debt goes to zero. Now, what does that do? Of course, that puts cash in the pockets of all the bond investors who then have to go figure out where to put it and what to invest in, and it probably creates asset bubbles all over the world. But again, it's a situation where you could literally fix the national. You could take the national debt to zero tomorrow if you really wanted to, if you were really incentivized to do so. So it's not really the worrisome mechanism here is probably inflation more than it is the actual debt itself. And so, like you said, I think it's important to think about what investments do you have that will make sure I not only keep up with inflation, but hopefully beat inflation by a little bit year after year after year, so I can grow, purchasing power. That's what we always try to think about. And that's why, as you mentioned, if you've got companies that can raise prices, if you've got assets that are scarce, whether that's land or Bitcoin or gold, whatever it is, those are the types of things that probably need to be core parts of the portfolio to make sure that you beat the inflation tax over time, because that's really honestly where we see the ongoing implication of it.
Yeah, well said. And I agree. And I think that's why, a lot of this stuff that's outside of our control, it's like, okay, whatever happened is going to happen. What can I do to hedge against the fear narratives, right? If they do play out, own Bitcoin, own assets, right? I think that's just kind of what we continually hammer. But I think it's good to do it even today. So, Nikki, talk a little bit. I wanted to ask you about this. You've been tweeting a lot, and I know you've been quiet so far. I'm sure you've got a lot that you want to say. Talk about what you consider the bifurcated economy, and who's doing well, who's getting screwed, and what are your thoughts on all this?
Yeah, I know. We thought we were done with the bifurcations, right? We thought we were kind of over that phase, but turns out we're not. You brought up real estate earlier, and I just wanted to kind of touch on this while you have the chart up. But it's been interesting to watch the divergence happening between existing home sales and new home sales. New home sales have actually been, kind of trying to ramp back up and increase. And then existing home sales, it's been a disaster, right? So it's just interesting to see that very clear difference between the two. I don't really know fully what to think of it yet. I mean, with the housing market is slow, we know this, and it's unfortunate builders aren't able to build enough. So it's going to be interesting to see what happens as interest rates stay, higher for longer. But yeah, this is the economy in a meme right now. Basically, we have winners and losers. So again, there's a bifurcation in real estate. There is a bifurcation right now between savers and people that hold variable debts. So if you think about it, people that have credit card debts, people that have HELOC, holding lines of credit that are variable rates going up and down as rates change, those people are hurting the worst, right? Who's winning right now? Savers. Savers are absolutely killing it right now because their high yield savings accounts are paying 5%. They're earning, 5% in treasuries or whatever it is. And I think that this is something that I've talked about before, is the idea of interest rates being a sort of stimulus for savers. Now, people are like, oh, well, credit card debt's ballooning and blah, blah, blah. I know, but you also have to look at assets that are held by the consumer. It's very interesting to note that even bank earnings, have given us some insight into balance sheets of consumers. And you just had the image up on the Daily Doe, the Daily Doe newsletter. If you want to go back to that image, you could see that this is Bank of America's latest report. And, consumer banking wise, balance sheets in terms of assets are still pre-pandemic levels, even though they've been drawn down a little bit. And so I think that it's important to keep that in mind. And when you look at things like, I've been looking at things like money market mutual funds, mutual fund balances. I've been looking at things like checkable deposits. I've been looking at the savings balances as well, which have been in drawdown. But you got to look at all these other things like checkable deposits. So I don't know. I just think that between retail, between real estate, between savers versus non-savers, I feel like we're still in this tug of war that I've been talking about forever, and I hate to say it because everybody hates that, but we're still in it.
So I know you've been talking and looking a lot at retail recently, like Target and Walmart, and you wrote about this in the Daily Doe recently, but what's kind of the latest? What are you seeing with the consumer? What are you seeing with retail?
So retail earnings has been very interesting. It's something that I pay attention to very closely. And right now, what we're seeing a choosy consumer, but we're not seeing necessarily a weak consumer, in my opinion. If you want to find a narrative, whether it's bullish or bearish with the consumer and with retail right now, you can go find it. If you want to be bullish, you can find it. If you want to be bearish, you can find it. And so that's kind of the tricky part about this environment. But you look at names that cater to lower income consumers like TJ Maxx, Walmart, Ross stores, all had positive positive sales. You look at Dick's Sporting Goods, even though the stock was down significantly from earnings because of theft, hurting the bottom line, they still had revenue growth going forward. And there are a number of other retailers that are very consumer discretionary that have done well. And then on the flip side, we have retailers that are sucking, like Foot Locker, right? Foot Locker did terrible. Their revenue was down almost 10%. Buckle, Urban Outfitters brand, Allbirds, Target, just to name a few. So right now you can kind of find good things and bad things in retail earnings, but this is what people need to remember. It's always been this way with retail earnings. There's always winners and losers in retail earnings because that's how it works. Trends, right? Consumer trends come and go. Brands become in and out of favor. Right now, Abercrombie & Fitch is extraordinarily in favor. They nailed it with a 16% revenue growth number. Their stock is flying, right? And that came out today. And so you're talking about a weak consumer. Well, okay, we need to look at all sides here. Is it a weak consumer, or is it consumers choosing different brands and trends? So that's where I'm at with the whole thing. And there's just bifurcations everywhere in my brain.
It seems like a lot of people, even though, we have inflation, even though, people have been getting squeezed and rates are up and all this stuff, it seems like there's still a pretty big risk appetite and people that are looking for alpha, and we can see that with, some, like you talked about, some retailers. We see it in the stock market. We also see it in crypto. One of the big recent narratives was the friend.tech kind of thing that's been blowing up over the past week or two. And I wrote about this in the Daily Doe, but I wanted to see if you guys are kind of seeing the same thing out there, or where you think kind of we are on the fear and greed index. But one thing that I think is just super interesting is, even as altcoins and like crypto in general is still way off of all-time highs, like people are still really excited about new projects. And if you just look at the activity of like the new users and the amount of capital that's been flowing into these new crypto projects, like the friend.tech thing, it's just incredible to me, like how much money, is being traded here and how much excitement is getting generated, even if, like, I wrote about all these red flags about the project, which, by the way, if anybody doesn't know what this is, friend.tech is basically a new like social platform where you can buy keys to access a private chat room with a user. And the more those keys are traded and the more people accumulate them, the higher the volume goes up. It's got some weird tokenomics. It's also got a kind of a shady anonymous development team. Plus it's got 10%, margins on transactions. So there's still a lot of things that aren't perfect about the project or the platform. But when I look at the amount of trading volume and just the amount of excitement that's still out there, it's pretty incredible.
Are you saying that people are just still speculating and spending money? And is that what you're saying?
People, at least in crypto, people want returns and people have capital and they're still chasing returns.
I know they still have capital.
Yeah, I mean, that's what you're saying. Like the bank account balances are at pre-pandemic levels.
That's what I'm trying to say. Like, unless I'm completely missing something in the data, people still have capital.
Mm-hmm.
So I don't know. I think that right now people are pulling a narrative from the savings number coming down, but are they looking at these other things, right? And that's where this has been a very challenging thing to navigate, because you can kind of create whatever narrative you want right now.
Interesting.
And pick and choose from the data. So I think people need to be careful, really, with who they're listening to and what data they're looking at. And I just think
you guys were even on a Twitter space the other day, and like, you don't have to name any names, but like, what happened, and like, what was everybody in agreement that the narrative was, and what are your opinions on that situation?
Everyone is horny for a credit crisis. I don't know why. I really
they are.
I
They
don't know
are.
why. I
Oh,
don't
man.
know why, but I've heard almost every day this week that a credit event is imminent. A credit event is imminent. And I'm
And
like
wage
pointing out,
inflation.
right, yeah, and that inflation's is going to reignite and it's going to be out of control. And maybe that's true. But when I look at signals, I'm looking at actual data to try to figure out what the reality is. Because look, in investing, it's more about the reality that plays out in markets, not necessarily your narrative. And so I'm looking at data and I'm like, okay, corporate credit spreads have tightened. It looks like that they are not indicating anything imminent in corporate credit land. So, okay, maybe you could say government bond yields, which were rising at the long end, the 10-year, the 30-year yields definitely were worrisome for us. And we called that out 3 weeks ago. And we said this could be the catalyst for a market pullback. So maybe the credit event comes in government credit, or maybe a credit event could come in something like real estate, commercial real estate, or the banking system. But if you're looking for evidence of that, it's just, even though we see rates rising, we just haven't seen where that credit event is going to happen. And so I'm not saying it's not going to happen, but we're monitoring, we're looking, we're trying to look at the actual data rather than just our opinions. And when we get on these spaces, it's funny because everybody is doom and gloom. Everybody says credit event, it's coming, inflation, the Fed's going to stay higher for longer. I'm like, when I look at the reality of all these different things, it's a much more nuanced and muddled picture. And while I do think I would like to see a bigger correction, it's not 100% clear that the sky is falling everywhere. And so I think that's obviously what we've all been saying for most of this episode. But yeah, people want the credit event. I'm not sure why, because if you remember back to 2008 or even back when SVB failed in March, it probably doesn't feel good to most investors and most people on Main Street when those types of things happen.
It does create good buying opportunities, though.
Well, I think we
That's
need to
true.
make this clear. We, at least Trav and I, want to see a deeper correction. Just because I'm over here saying, yeah, there's good and bad, and we're still dealing with that kind of lukewarm environment, and the consumer might end up stronger than we think. Even though I'm saying all of that, that's just me explaining why the market could potentially hold up, but that doesn't mean I don't want to see a correction. I do. I want to see better valuations. I don't love the idea of buying the S&P at 19 times earnings. I don't love the idea of buying certain individual stocks, at some of the valuations that they are right now.
And to agree with you, in Bitcoin, I'd love to see prices get cut in half again before the halving. That would be a blessing. In March of 2020, when we got the COVID panic, that was one of, if not the best buying opportunities of the past 5 or 10 years. And we were there for it. So yeah, let's bring on the panic. But I think what we're saying is we can entertain the fear-based narratives. We can look at the looming risks, but also not let it shake our conviction in trades and not make us not want to participate, right? If anything, it'll be if that stuff does happen, oh, cool, we get buying opportunities, or we get other opportunities that pop up, right? So it's not the end of the markets.
Well, that's the problem, right? We're all trying to just allocate properly. We're all trying to not make mistakes. Do you know how many people missed out on the rally from the lows of 2022? So many people, right? And we were participating. We were still buying stocks. We were buying Meta, at the lows, and we were jumping in, and we weren't ignoring the possibilities of more downside and more risk, but we were also seeing the other side of it to give us enough confidence to make some moves. And it's there are a lot of people that listen to these narratives and they completely miss everything. And that's where I get heated and frustrated with a lot of the doom and gloom narratives. It's you can look at both sides of the data, and you can still want to see a pullback, but at the same time realize if the data is not supporting it, you need to be allocating capital, period.
Well
right
said.
So that's where I'm at.
Let's talk about an investing theme that can spark fear in the hearts of people around the globe. Trav, you wrote about you wrote a brief in the Daily Doe called "Will This Investment Go Nuclear?" And then you proposed the question, are we on the cusp of a nuclear renaissance? And could that mean brighter days ahead for uranium markets? You've been talking about uranium, I think, for a few years. I think I remember you were talking about this back during COVID when prices were way cheaper. But what's the opportunity here? What's your thesis? And should people be terrified?
Yeah, I'm more terrified of governments screwing up energy policy and hurting the nuclear industry than anything else, because we've seen the world go from 450 nuclear reactors down to 437. We saw countries like Germany and Japan decommissioning reactors. The US really hasn't built net new reactors in a number of years. And this is at the same time we have EVs and electrification happening all over the place. So we've got more demand for electricity than ever. We've got a hotter summer than we've had in a lot of places. So we've got more use of ACs. So point being, you've got a rise in demand and you have them pulling off supply, which is extremely stable and dependable. And, you know, I talked about the Oppenheimer movie because it was a really highly anticipated film. And I was excited about it because I've studied the nuclear industry for a long time. And the sad reality, though, is that 80 years post the Manhattan Project, we are not harnessing nuclear power in a greater way. So, yeah, I talk about that in the Daily Doe, but it does look like things could be changing. And it looks like, particularly in places like Asia, you've got China and India building up to 60 new reactors. They've got a lot of those under construction already. And interesting things happening in the uranium market, which is a very small market, very sleepy market. But back in 2006, 2007, we saw uranium prices go from like $30 or $40 a pound up to like $150 a pound. And so they basically went up 4x in a matter of a year. And that's why I've been watching the uranium market for the past couple of years, because we're seeing similar signs that a squeeze could happen. We've seen a lot of the major producers have issues with their mines. There's geopolitical problems. Niger just had a coup, and they're going to stop exporting uranium, at least for some time, to France, which has a big base of installed uranium or nuclear reactors. So a lot of interesting dynamics happening in the uranium market. And so I think it could be a situation where we see this chart go potentially parabolic. It's done well in the past year or two quietly, but I think conditions are there potentially for the uranium trade to work on an even greater basis. So
what are some ways that people can participate in this?
Yeah, so there's, three major producers of uranium globally. There's Orano, which is a private company out of France. There's Kazatomprom, which is out of Kazakhstan, and they share a massive border with Russia, so it's hard for them to even get their uranium to market in some ways. And then there's Cameco up in Canada, and they're the largest producer in North America. And so Cameco and Kazatomprom are public.
What's their
technically? CCJ is Cameco. And interestingly enough, Stanley Druckenmiller, the famous macro investor who has one of the best track records in macro investing over the past 2 decades, his firm took a small position in Cameco CCJ last quarter. So he's a little bit late to that trade, it looks like, but there may be still juice to squeeze from the orange, so to speak. And you always like to have Druckenmiller on your side because he's a great momentum macro investor. But I don't love those plays as much as just a pure uranium price ETF like the Sprott Uranium Trust, which is traded on Canadian exchanges as well as over the counter in the US. What's interesting about the Sprott Physical Uranium Trust is that, it's been buying uranium in the physical spot market. So it owns a bunch of uranium and it trades for a slight discount to the market value of that uranium. And there's a potential situation, obviously, if uranium prices go parabolic, that the value of those holdings will grow significantly. And so you're not really paying up for that exposure today, which is nice. Whereas with the uranium miners, they're trading at pretty high valuations when you look at things like price to earnings ratio for Cameco. So I kind of like the play of just owning the physical commodity itself through something like a Sprott Physical Uranium Trust, or there's a new one in Europe called Zuri, and that one's out of Switzerland. So there's some options there to actually have essentially direct exposure to uranium price, which I think is interesting. So
yeah, this Sprott chart is looking primed for a breakout as well. It's on TradingView. It's U.UN, trades on the Toronto Stock Exchange, TSX.
Yep.
So
and trades over the counter in the US. So there are ways to buy it for US investors. I think the over the counter ticker is like SRUUF for that Sprott Physical Uranium Trust on the US markets.
SRUUF. Oh yeah, there you go. That's on the penny stock market. All right. Talking about, just kind of the world and what's happening right now. We've got record heat popping up all over the place. And, Chicago's got a feel like of 109 It's pretty wild. Trav, I know you've been keeping it cool over there in Texas, but millions of people face dangerous heat indices of feels like values of 110 to 120 degrees Fahrenheit. It's pretty wild.
California got a hurricane.
Yeah. Well, we had 45 straight days of greater than 100 Fahrenheit heat here in Texas. And we just broke it yesterday because it rained for the first time in like 2 months. So we only got up to 99 Fahrenheit yesterday.
What a treat.
Yeah, it's been a tough summer. Our buddy Sam even tweeted yesterday that, you know, he kind of regrets moving to Austin because of the brutal summer. And I said, hey, this one's particularly brutal. It's not always this bad, but it's pretty bad. Yeah.
Yeah. What are some ways to play the kind of the rising temperatures, right? Like I know generators and there's certain plays that can be like seasonal with that.
Yeah, and you've got like AC manufacturers and service companies like Carrier that are public. There's a couple of those actually. And, you know, it's interesting to think about places like Europe where you have a lot lower intensity of air conditioning, a lot lower penetration. And those numbers could go a lot higher if we continue to see warming. So AC penetration could increase. So companies like Carrier or the Linux International is publicly traded. So those would be a couple companies to look out for that are direct plays. Generac, which is a play that we've talked about in the past, that they make generators. So for people that are looking to get independence from the electrical grid, which is increasingly strained. And we even lost power in Texas a few times because of it. So there's
Generac had a massive bubble during the COVID panic.
Yep. Yeah, and that's one I've been watching and waiting to come down to my price zone where I want to buy it at, and it just missed getting there back a couple months ago. So I'm hoping the correction will continue there. They've had some issues with, they had a huge boost during the pandemic, and then of course they've seen a lot of that slow down. So now long term, the question is, can they continue to compound higher sales? And I think that's probably the case, but right now they're going through a bit of a transition again.
Okay. Well, what else are you guys looking forward to over the next week? Any big news events? Any earnings? Obviously, we've got not Netflix, but Nvidia at 4 o'clock today. Any other big events or key charts that you're looking at?
I'm still trying to figure out if what we're looking at in the S&P 500 is going to be just a bounce that people are going to short, into for a lower sell-off into 4,200, or if this is actually going to hold up and we're not going to see lower. That's kind of the big thing, kind of similar to Bitcoin. Bitcoin's at a really key major level right now with the 25,000 zone. So I think paying attention to price action over the next week is going to be really, really key to kind of give us a hint into how to allocate going forward. Because I'm still sitting on cash to allocate, but just hanging on a little bit longer to see where price action takes us.
Yeah, the Fed has their big Jackson Hole symposium on Thursday and Friday. So we'll get to hear from Chairman Powell and some of the central bankers on how they're thinking about rates. So that could have a big impact on the market. So we'll be tuning in for that. Unfortunately, we have to listen to every little statement that the central bankers make now. But that's our world as investors. So we'll be tuning in for the Jackson Hole stuff. Of course, we'll be watching some of those critical industries and ETFs, like the banking ETFs, KRE, and obviously what's happening with tech at post Nvidia earnings. So those are going to be things that I'll be tuning into as we end the week.
Yeah, it looks like the probabilities for a rate hike are still lower than 50%. And then rates are projected to drop into the spring and summer next year. So you guys think the markets are pricing this right, or you project higher rates or a cut earlier this year?
Yeah, it's interesting. It's been the rate cuts have been slowly getting pushed out in terms of the probabilities. So the market wanted and was expecting rate cuts to happen, late 2023 or very early 2024. Now that's starting to get pushed out a bit in terms of the market's probabilities. But I think we're one market crisis away, or one deep market correction away from the Fed being completely done and it being completely obvious that they're going to need to cut rates in 2024. I've been saying over and over, I'll say it again. I think the Fed's already made the mistake of being too tight and having rates too high. They're talking now about, should another rate hike be on the table? That's insane. Let's see what happens through the fall, because I think, again, we're one short market crisis away from the Fed being forced to cut. And maybe that comes from housing market, or it comes from commercial real estate, or it comes from the banking system. But, I think we're much closer to the end of the hiking cycle. And I would expect that 2024, we see rate cuts.
All right. Awesome. Nikki, anything you're looking at?
No, same thing. I mean, I'm looking at Lululemon earnings coming up. That's going to be another kind of look into the consumer and continuing to kind of pick apart this narrative on how and which consumer is doing well, which consumer isn't. So just adding that to the list. But yeah, same thing as Trav, looking at all that, looking at Jackson Hole, hearing what we're going to hear out of that and how the markets are going to react to it. I'm expecting more hawkish talk. I don't know. We'll have to just see.
Cool. Well, we'll keep our eye on the Bitcoin and indices pullback. We'll see what happens here in just an hour or so with Nvidia's earnings, and the AI boom is going to continue, and people are going to keep buying up GPUs.
Can we confirm? How do you say is it Nvidia or is it? How do you say it?
Travis.
Can someone school me?
Cringing as I was saying that.
Nvidia.
It hurts me to hear Nvidia.
Nvidia. Is that?
I just say like the letter N, and then Nvidia. That's it. That's all you need.
Nvidia.
Nvidia.
So I'm like, I was saying
well,
they did say that, Nvidia.
You probably said it right.
Didn't I
was
say
saying
that?
it like a country boy.
Hey, it's all good. I think Nvidia just needs to claim the AI ticker and just take that over. It's sad that some other crappy company has it, and then we can just call them AI.
Awesome. All right. Well, guys, we'll see you next week. Pay attention to these dips. Go subscribe to our YouTube channel. Go to wetalkmoney.com/community. Check out our community. Travis got a big options webinar coming up in a week or two. We'll send you guys info about that. And stay safe out there, because we've got some looming risks and looming trouble.
Doom and gloom.
Yes. All right, guys. Have a great one. We'll see you next week.